Welcome back, listeners, to another episode of Simple Mind Space, the podcast dedicated to helping you master your money and your mind. Today, we're diving deep into a fascinating and crucial aspect of finance, the ripple effects of interest rates. You see, interest rates are much more than just numbers on a bank statement. They're powerful levers that can steer the entire economy, impacting everything from your mortgage payments to global market trends. Think back to the early 2000s, the era of dial-up internet and the dot-com boom. The stock market was on fire, valuations skyrocketed, and everyone wanted a piece of the tech pie. But like a rocket running out of fuel, the dot-com bubble eventually burst, sending shockwaves through the financial world. The stock market plummeted, wiping out nearly $5 trillion in value and plunging the economy into a recession. Now, imagine you're the Federal Reserve, the entity responsible for keeping the U.S. economy stable. What do? You need to stimulate growth and get things moving again. Enter the power of interest rates. The Fed, in a bid to revive the economy, decided to make borrowing money cheaper and more appealing. They slashed interest rates from around 3% to a staggeringly low 1%. This move was like opening the floodgates of capital. Suddenly, taking out a loan for a new car, a dream home, or even starting a business became significantly less daunting. Businesses, fueled by these low borrowing costs, began to invest and expand. Consumers, enticed by low-interest loans, started spending again. The economy, like a patient receiving a dose of much-needed medicine, began to show signs of recovery. By 2003, the recession was easing, and by 2006, the stock market had fully recovered, reaching pre-dot-com crash levels. But this economic rebound, fueled by low interest rates, had an unintended consequence. It made traditional safe haven investments like government bonds and fixed deposits less attractive. Think about it. Why settle for a measly 1% return on a government bond when the stock market is roaring back to life, promising significantly higher returns? Investors, particularly those who had experienced the heady gains of the dot-com boom, were hungry for the next big opportunity, a chance to multiply their wealth. The allure of low interest rates wasn't just limited to the stock market. It spilled over into the real estate sector, creating a perfect storm. As interest rates plummeted, mortgages became more affordable, prompting a surge in home buying. Demand for homes shot up, and as we know from basic economics, when demand outstrips supply, prices rise. This is exactly what happened in the housing market. Home prices began to climb, quickly becoming a lucrative investment opportunity. Financial institutions, always eager to capitalize on a trend, saw this as a golden opportunity. They bundled these mortgages together, creating mortgage-backed securities, and sold them to investors as a way to invest in the booming housing market. These securities were initially incredibly successful, generating attractive returns for investors. This success, however, was built on a shaky foundation. Remember those low interest rates? They were a double-edged sword. While they made mortgages more accessible, they also led to a relaxation in lending standards. Banks, eager to issue more mortgages and package them into these profitable securities, started approving loans for borrowers with poor credit histories and low credit scores. Individuals who, under normal circumstances, would have struggled to secure a mortgage. These risky borrowers, often referred to as subprime borrowers, were now entering the housing market in droves. They were enticed by the prospect of homeownership, often lured in with promises of low initial payments that would later adjust to much higher rates. These adjustable rate mortgages seemed manageable at first, but quickly became a burden when interest rates inevitably rose. The problem was that this entire system was built on the premise of ever-rising home prices. Investors, blinded by the allure of high returns, believed that even if borrowers defaulted on their mortgages, the banks could simply foreclose on the properties, sell them at a profit, and everyone would be happy. But as with all bubbles, this one was destined to pop. When interest rates began to rise, adjustable rate mortgages reset at higher monthly payments, catching many subprime borrowers off guard. They found themselves unable to afford their mortgage payments, leading to a wave of defaults. As more and more borrowers defaulted, the once booming housing market took a turn for the worse. A flood of houses hit the market, far exceeding buyer demand. This imbalance triggered a sharp decline in home prices. Remember those mortgage-backed securities that were once considered safe and profitable? Their value was directly tied to the underlying mortgages and the value of the homes themselves. As home prices plummeted, these securities became practically worthless, triggering a cascade of losses for investors, banks, and financial institutions. The financial system, heavily leveraged on these now toxic assets, began to crumble. Banks, saddled with bad debts and facing a liquidity crisis, were unable to lend to each other or to businesses. The credit markets froze, bringing the economy to a grinding halt. The situation spiraled into what we now know as the 2008 financial crisis, the worst economic downturn since the Great Depression. The story of the 2008 financial crisis is a stark reminder of the interconnectedness of the global economy and the far-reaching consequences of seemingly isolated events. It highlights the potent role interest rates play in shaping economic landscapes, influencing everything from investment decisions to the availability of credit. Understanding these concepts is not just for economists and policymakers, it's crucial for everyone. By grasping how interest rates influence markets, investments, and even your personal finances, you can make more informed decisions and navigate the complexities of the financial world with greater confidence. Remember, knowledge is power, especially when it comes to your money. That's it for today's deep dive into the world of interest rates and their ripple effects. I hope you found this exploration insightful and empowering. If you enjoyed this episode and learned something new, don't forget to like, share, and subscribe to Simple Mind Space so you don't miss out on future discussions designed to empower you on your journey to financial and personal mastery. Until next time, keep those minds sharp and those financial goals within reach.